Okay, mate. Let's have a look here. AOA. Now, the first time, generally the first time you kind of come into an apex like this, it usually fails a little bit before making that real move. That's quite a common occurrence. That it just doesn't run from here and maybe it has that dip just to allow this to round out and the pattern to develop a little bit more. Now, kind of like this, for example, you get that pop into it. We got that pop into it. And then as it develops, you get that drop away before the real move. Okay. So if we do get a drop here, um, it's a shame that this is quite far away because it would leave quite a bit of distance between the higher lows. Like here, you can see the equal lows allowed for that to move higher. In this circumstance, there would be a big distance between these higher lows, depending on how low it dips, of course. And even if it actually gets back into that apex, what if we roll away like this? What if this is what you need to be concerned about. What if price does fall under this apex and never sustains above the white 100 moving average in bearish? So what if it actually rolls over from here without actually working into the apex? That's that's the concern in all of this, and that's why I'm saying I don't like the fact that there's only there's a big distance here between this low and then up here. For example, if I just zoom out here, you can see that the market never usually likes to leave an area untapped. And the reason being is there's too much liquidity down there. Usually, of course, if the market's going to turn really bullish, it can happen, of course. Let's go back here. It's only a short chart. Like if you look at this whole move, like the only part that was untapped. Well, we put a low on here, and you can see that this little spike. If I actually move this down here, this little spike here was the only point that was untapped, and you can see a little bit drop below here. So it even came down later on to take out most of the long people, and you can see that this little tiny little bit here is the only bit that's untapped. Okay, so the market loves to come back and run all stops before then potentially moving higher. It's a common occurrence. It doesn't always happen, but it's pretty common. I have made a video about the market makers in the education section, in the crypto check video section. Now, if we flip out to the monthly, you can see here that we've had a little spike up, and price at this point looks like it wants to come down and take liquidity into this wick. Okay, so that fits with my original thesis that we will probably want to drop down out of this 4-hour apex. At least drop down for that spike, and that will take liquidity, as I mentioned earlier, out of that wick. And then if we can see some strength as it does do that dip, then you want to be buying this with a fairly tight stop. With a fairly tight stop to see if this can actually move back up into this apex. If the apex manages to hold and the market's bullish enough, then we could see a breakout. So, when you get 2 large months down like that, there definitely is the potential to get some sort of rebound. On worst case scenario, we are going to have another instance like this, right? Where we need 3 or 4 months down here before this moves back up. But I think the safer option, if you're looking to buy for a bounce, is to buy into this wick. Okay, I forgot you had another one. The video is going to be a bit longer. TKY. So ideally on TKY here, ideally what we would like to see some point this month, you'd like to see that retrace back up, like we had a retrace back up here. And these are probably decent bounces, just for reference. I mean, that's 15% bounce. It's a bearish candle, it's a bearish setup, but you can see any examples? Like This is a similar candle and this is a similar candle. Both of these are actually 3 in a row here are similar candles with a long wick on top and long wick on bottom. And you can see a long wick on top and a long wick on bottom. But each candle at some point in the month has that 15% bounce back in. The next one also has a 15 to 20% bounce back in, and this one is a bit smaller. So it shows at some point in the month that generally, and that's another common occurrence. You can see that this pivot here. I like to target this pivot when looking to get this bounce back up for the month, and it can potentially roll over again. I wouldn't be surprised. I wouldn't want to be holding this. That's a 45% bounce. God, that's a lot. You know, even if it does bounce, it can potentially bounce and roll over, as you can see here. You know, bounce and roll over, back down, and then maybe you form a base, for example, on the lows and get that big bounce up. So if you're playing it, I would just play it for the bounce until we can see this market is improving and developing. There's bearish structures in this market at this point in time, at least warning structures that you need to be more careful. You know, when you break down below all of these moving averages, it can take time to develop before actually getting a move up. This is not ideal circumstances to be buying this chop. If we manage to get a stop onto these lows, for example, I mean that would be fantastic. In this environment, it's best to only take the best setups really to be safe. I don't consider this being the best setup. Personally, when I see this setup, right, when you get into this white 100 moving average, I do like sometimes to play that little pop. You can get a little pop from here. But what I like to see is this white 100 moving average curling down and price getting above this, and it'll usually consolidate here, right? And then you can look to buy that for that move up out of this kind of apex, right? But buying in here, it's early in the development of the pattern. Usually it's safer to let the pattern develop and see if you can see some bullish structure. So I just don't believe that this is ready for safe buying.